Hi class, and welcome to this VCE Year 12 Economics video, which is going to cover the topic of the business cycle. Now this is part of Unit 3 Outcome 2, Domestic Macroeconomic Goals, and I hope by the end of this video that you really understand what we mean by the business cycle, and importantly you understand the type of business cycles you might be exposed to, the nature and cause of them. So what are we going to see in the different types of business cycles, what might cause them, and how does this interact to create the overall business cycle? So what is the business cycle? What are we talking about here? The business cycle refers to the fluctuating pattern rates of economic growth in our economy. We understand our economy goes through different rates of growth. How do we measure growth in an economy? Gross domestic product. So economists have noted that the level of economic activity, GDP, tends to go through what we call cyclical movements. This is where we have periods of above average GDP and some periods with below average growth in GDP. And this is what we mean by the business cycle and the cyclical nature. You can see here that we have what we would say is the long run trend of economic growth. So the average economic growth in this theoretical economy is 3%. And you can see there are times when we have above average growth and sometimes when we have below average growth. And what does this look like? It looks like what we would say is a cycle of got the ups and downs of life of our economy. And this is what we mean by the business cycle. So you're welcome to pause and have a look at this. And you can see there are some terms like peaks, troughs, recoveries, and downturns. These are the terminology that I hope that you become comfortable by the end of this video. Now, this is just another way of showing these different types of cycles. So you're welcome to have a look at this. There's a bit more detail in here. What we're interested in is starting to get an understanding of how we can identify the above average periods and the below average periods of growth and start to recognize what we're going to call these and what you'd expect to see in the economic conditions in these types of cycles. If we look at Australia, before we do that, you might be able to note or have an investigation of what Australia's gross domestic product has been doing. And you can see since September 2013, all the way up to 2020, early 2020, it's been pretty positive. The GDP growth, so this would be GDP growth, as a percentage, has consistently been positive. So it's been a genuinely positive cycle. What happened in 2020? COVID struck and destroyed all that positive growth. We started to have some negative growth, a giant one of roughly negative 7%. And then we've had some large increases as the economy recovered. And in 2021, a reduction again, as we might remember, COVID led to more lockdowns. So the lockdowns in Australia led to a reduction in growth, which makes sense. When we are talking about business cycles, we're going to hopefully start to understand that there are 4 distinct phases or stages in the business cycle. And we're going to go through all 4. And we're going to chuck a 5th one in there, which is an interesting one, which we haven't seen, thankfully, for a long time in Australia. When we talk about the 4 cycles, we're going to talk about peaks. And a peak is a period where in the business cycle where there is strong growth in real GDP, so really strong growth. We're going to talk about contractions or downturns. This is where an economy cannot stay in a peak forever. We can't have strong growth all the time. So then we're going to have a period of slowing or falling of real GDP. Troughs are where the rate of real GDP reaches the most low point. And this may even be below 0%, just like when COVID hit. And if negative rates occur for 2 quarters, this is when we're talking about a concept called a recession, something we did have in 2020. Once we hit a trough, we will then have a recovery. This is where rates in growth in real GDP start to recover and increase again to above the long-term trend. So if we think about this as a cycle, we're going to continually go through these 4 cycles. Let's assume the economy is at a peak, so the best time. This is not sustainable, so we're then going to have a contraction or a downturn, leading to a trough and then a recovery. So we're going to have a peak, a downturn, a trough, then recovery, hopefully leading to another peak. So you hopefully are starting to see that there is a cycle in this business cycle. And as we just described, the economic activity often travels from a peak through a slowdown or contraction, past domestic stability to a trough, so the low, and an expansion or recovery then occurs as we go straight back up to a peak. But what does it actually mean in each of these cycles? When we are in a peak, the business cycle is characterized by a few things. There is strong rates of economic growth, high level of consumer and business confidence. Real GDP is high. Consumers and businesses are really confident. We are spending and investing. There is a higher propensity to spend and take on debt, which encourages expanded production and supply. Consumers are confident, so we spend. Businesses are confident, so they take on debt to expand. This actually leads to more and more growth. There is an increased demand for labour. We need more labour, more people to work to meet expanded supply needs. This might lead to an increase in wages. Now note some peaks may be considered, and I've crossed that off a little bit, booms. Booms might sound great because the growth is really, really high, but this may be considered excessive and unsustainable due to the pressure of inflation. We'll talk about a bit of inflation more, but if growth goes for too much, we might start to see our price rises going up because there's so much demand for everything. And this pushes the economy into the next phase of the cycle, which we know is a downturn. So what are you going to start to see in terms of some real key indicators? GDP in a peak is at its highest point. Unemployment is at its lowest point because we need lots of labour. And inflation, inflation are our price rises, is going to be at its highest point. Everyone is trying to buy things. There is a race to try and get goods and services. This leads to our prices going up. This leads to a contraction or a downturn. It is characterized by potentially excessive rates of inflation. So think about the peak, price rises were going up. This is going to lead to an excessive rate of inflation, and this leads to higher interest rates. And this constraint creates capacity constraints. This is where we're starting to get to the point where we can't grow any further because our prices are going up. The price of debt is going up. We've reached the point where we have to have a downturn. When this happens, businesses and consumers recognize this, and their consumer confidence or business confidence deteriorates. This leads to a fall in private consumption and investments, exacerbating the downturn as we go down in the cycle. From the height of the peak, we're going down the downturn. So we're having our downturn as confidence goes down. This leads to our slowing economic growth, a little bit more increased unemployment, and we start to keep going down and down in our cycle. What is this characterized? What are the things you're going to see in a contraction or a downturn? GDP might be rising more slowly or probably more likely falling. Unemployment will start to rise And as we have more unemployment, less growth, the price pressure, so inflation, is going to start to go down. It might start to slow because we're taking the heat out of the economy. We then get to, if we've gone from a peak all the way down the contraction, we then hit our trough. The trough in the business cycle is characterized by the economic activity is at its lowest point. And you can see I've done this here. The economic activity is in the trough. GDP is at its lowest. Firms need fewer resources, so the unemployment rises. Less growth, less resources, less labor required. There is a really low level of consumer and business confidence. Unemployment rises leads to consumer confidence going down. You're not having confidence if you're worried about your job. Businesses are not feeling confident because consumers don't have the money, the income to buy their goods and services. This leads to a lack of spending by both, and this creates a bit of a vicious cycle. This leads to low inflation levels because there is sometimes even deflation where prices actually aren't rising slower, they actually drop, and lower interest rates because we're trying to get to the point where we get out of this trough. So we're trying to increase spending, which is a bit hard when low consumer business confidence is occurring. So how do we try and get that confidence back up? Lower interest rates, try and encourage some spending and some investment. Now note, some troughs may become recessions when 2 consecutive quarters of negative economic growth occurred. A prolonged recession is known as a depression. We had one in 1930s in Australia. And we did have a recession in 2020 when 2 quarters of growth was negative due to the COVID lockdowns. This was some of the first recessions, I believe, in 30 years in Australia. So we had a good run. What will you see in a trough? GDP is at its lowest point. It could be even negative. And if we have 2 of them, that could equal a recession. Unemployment is at its highest point, and inflation is at its lowest point. It might even be negative if we have deflation. That might be occurring if we have a recession. This doesn't last forever. We have our peak, our contraction, we hit our trough. The trough is the lowest point, and we start to have our recovery. A recovery in the business cycle is characterized by low inflation, interest rates, and labor. Low costs of goods, getting cash debt is at low cost, and wages are low. So this starts to create an increase in our supply and demand. We are in the conditions for a recovery because things are cheap to buy, debt is easy to get and cheap to get, wages are cheap, so businesses start to expand. This leads to a growth in production, which should then lead to a growth in employment, income and expenditure as we start to have our recovery. So we start to see stabilizing economic growth, inflation and interest rates. We start to get back to where we wanted to be. So we start to recover and hit our average as we are hitting our targets, and we're starting to see GDP increase, unemployment fall, and inflation rise. Now they're the 4 categories. There is one other one called stagflation, which we don't want to get to. The business cycle diagram assumes that inflation and unemployment are opposite situations. So we shouldn't never get to the situation where inflation is high and unemployment is also high. We should never be in the situation where we have both those bad things. However, sometimes the economy simultaneously experiences a stagnant level of production combined with high inflation and high unemployment. That is a bad thing because prices are rising and also we're having lots of people out of job. And you can imagine what it's like for someone in the period of stagflation. If there's not much production, prices are going up, and there's lots of unemployment. So in 1973 to 1983, unemployment actually peaked at 10%, but we had inflation at 11.6% at the same time. Tough to be unemployed at that point. Possible reasons could have been the end of the post-war economic boom. There was an oil crisis. There was international competition. Lots of things had to be out of whack for that. Now, there has been some talk that COVID could lead to some of those things. Inflation is quite high, and there has been some concerns about unemployment, but unemployment has thankfully remained quite low at this time. But let's to summarize, if we had stagflation, GDP would be slow or it may be even negative, but unemployment is high and inflation will be high. Now, can you identify, and we've already done this a little bit, can you start to maybe identify some of these phases? We clearly had hopefully a trough here and hopefully a trough here. We've got some low economic growth, and you can see there was a negative one here. So we had a recession. But can you identify some other aspects of the business cycle? Perhaps this is a peak, maybe even a boom. It was quite high. But can you identify some other of these phases in the Australian economy? But I hope this video has helped you understand the business cycle, the 4 parts of it. We are going to have peaks, downturns. We are going to have troughs. And then we are going to have a recovery. And can you understand the nature and causes of these? In particular, what are you going to start to see in terms of GDP, inflation, and unemployment in each of these phases? I hope you enjoyed this video and found it useful to build your understanding of the business cycle.